and welcome everyone. Thanks to all of you for joining us for this IAA member briefing call. We appreciate your being a part of this terrific community and look forward to seeing many of you next month at our industry-leading compliance conference. We have a lot to talk about today with this intense policy environment, and we have an excellent team here to decode all the latest developments, including a few that occurred this week. I'm joined by our MC, Gail Bernstein, the IAA's General Counsel, as well as by Neil Simon, our Vice President of Government Relations, and the IAA's expert legal team, Monique Botkin, Diane Decoteau, Laura Grossman, Sanjay Lamba, and William Nelson. I'll spend just a minute on the policy landscape before turning it over to Gail. Let's face it, our industry has had to deal with a challenging policy environment this past couple of years, and it's not letting up anytime soon. We're seeing a very aggressive policy agenda affecting our industry, mostly from the SEC. They're giving us little time to analyze the proposals and short comment periods, and they're really rushing these rules through. We're also seeing an increasingly polarized Congress and challenging state issues as well. The policy landscape reflects broad themes that will continue to play out through 2023. For example, the administration's continuing focus on climate risk is permeating the agenda across agencies. Market conditions are highlighting the importance of a balanced narrative around active and passive management and making sure that policy remains strategy neutral. The SEC is overwhelming advisors with a slew of proposed requirements on cybersecurity, oversight of service providers, private fund advisor agreements, beneficial ownership reporting, and much more. What it means to serve clients as a fiduciary is front and center in these rulemakings and in the SEC's exam and enforcement. We are seeing this SEC move away from the long-standing principles-based approach that has served investors well to more of a command and control approach to regulation. The IAA brings our members together to advocate on behalf of the industry in response to this tidal wave of regulation. We are laser focused on educating policymakers about the cumulative impact of these regulations on all of your businesses. And we're working to ensure that policymakers acknowledge and take into account the effect of regulation on small businesses, which are the core of our industry. I'm going to turn it over now to Gail to discuss how these themes are playing out, what the takeaways are, and how we ensure that your voice is heard.
Thank you, Karen. Well, a hot off the presses development in this fast-moving policy landscape is yesterday's announcement that the SEC will consider proposing amendments to the custody rule at an open meeting on Wednesday. We will, of course, follow these developments closely, and we'll talk about them a little bit later. Before we turn to our outlook on policy, I'd like to start us off with how the industry has been adapting to the new marketing rule. Sanjay, what does this new rule mean for our industry? And what kinds of challenges are you seeing now that the rule has gone into effect?
Great, thanks, Gail. Yeah, so after a long 18-month transition period, the new SEC marketing rule for advisors came into effect last November, replacing old rules that had been on the book for the past 60 years or so, and greatly expanding the definition of advertising, now potentially covering all sorts of communications, including communications to prospective clients, as well as to your current clients that go beyond your existing ordinary course advisor-client communications. So, for example, while client account statements are not covered, offering new advisory services to existing clients that expand the current relationship would be covered. The new rule also covers communications to private firms your funds may manage, and both formal and non-formal solicitation agreements, now referred to as testimonials or endorsements, are also covered under the marketing rule. This includes solicitor arrangements where you're paying cash or non-cash compensation. Next slide, please. But I do believe that the new rule is a vast improvement over the old rule and really does provide many new opportunities for your shops to communicate with investors and offer advisory services, including, for example, the ability to use case studies or highlighting specific recommendations or investments to demonstrate your investment philosophy or strategies. You can now use testimonials and endorsements, including on social media that was not allowed under the old rule. And you have clear guidance on being able to publish pure educational materials through, educational materials or thought pieces for the benefit of investors, particularly retail investors. Now, it is true that advisors spent almost the entire 18-month transition period developing a new compliance program for the new rule, and that was very important. And the IAA has been with our members every step of the way, including through regular meetings of our marketing implementation group and developing new resources just for members like our compliance checklist. But now that the dust has settled and your compliance programs are in place, it's back to business, so to speak, under the new rule. And firms are rightfully trying to figure out what this all means for your business and what opportunities the new rule might present. Next slide, please. And not surprisingly, there has been a push and pull between two competing goals at your firms. On the one hand, the very important goal of growing your business through marketing and social media. And on the other hand, staying within the regulatory guardrails of the marketing rule. Now, today I'm going to discuss three areas under the new rule that I've been getting the most questions on that I think reflects this push and pull. I'm going to start off with presenting gross performance numbers in your marketing materials. Most notably, the requirement that if you present gross performance in your marketing materials, you must also present net performance that includes the deduction of, among other things, your management fees. This is true regardless of who you're marketing to, retail investors, sophisticated investors, or even to an institutional investor. This is an unfortunate change from the old rule. And the SEC staff recently clarified that even if you display the gross performance of one investment, so for example, in a case study, or a group of investments from a private fund investor, for example, the advisor must show net performance of the single investment and the group of investments, period, no exceptions. This would be considered extracted performance under the marketing rule. Now, this is true even if you want to show total gross and total net, and then also show the performance results of all investments in a portfolio on an individual gross basis. So for example, in a table. In these situations, the SEC staff clarified that you would have to show the net performance of each individual investment in the table. Now, just one more clarification that we got from the SEC, this requirement would apply to advisor communications across the board, not just to private funds, but both as separately managed accounts as well as private funds. Now, moving on, the other issue that we get asked about are situations where one of your portfolio managers, for example, goes on a live TV show or radio show for an interview. And then the key word here is live. Now, fortunately, the SEC excluded from the definition of advertisements live communications that are made without any written preparation. So if they're just speaking off the cuff, not covered under the marketing rule. But if your portfolio manager is talking off written notes or a slide presentation, those would be considered advertisements subject to the marketing rule. Now, the one question we get asked is, what happens if the advisor wants to take a recording of that interview and post it on his website or share it via social media? Under the marketing rule, the SEC, the commission clarified that the recording itself would be considered an advertisement subject to the rule. So if you want to use interviews in your marketing materials, you should plan ahead accordingly with your portfolio manager before they do the interview. Now, one area that we were hoping that the SEC would provide some clarification is social media, and they have. And so this is the last issue that I want to mention, which is the use of social media by the firm and your employees. Now, the new rule does provide guidance as we had hoped for. So, for example, an advisor can now permit the endorse feature, likes or shares on your social media pages. So, for example, your LinkedIn page. The guidance also covers social media usage by employees. Here, the SEC said that if you adopt written policies and procedures that are reasonably designed regarding the use, are reasonably designed to prevent the use of an employee's social media account for marketing or advisory services, the SEC generally would not consider such communications the advisor's marketing materials if you have effective supervision controls in place. Okay, so I'm out of time, but before I finish, I do want to emphasize that sort of despite all the hurdles in the marketing rule, I really do believe that the new rule offers a lot of opportunities for firms to communicate with investors. So I encourage you all to sort of take a look at the rule. And if you have any questions, certainly you can call us. Back to you, Gail.
Thank you, Sanjay. So one of the developments that just happened this week is that the SEC published its 2023 exam priorities. Not surprisingly, compliance with the new marketing rule is a major area of focus. We're going to discuss this in more detail in a webinar that we'll schedule on the exam priorities. But before we move on to something else, Sanjay, do you want to quickly highlight some of the resources that we have for members on this new rule?
Yeah, so I already mentioned our marketing implementation group, which meets regularly. And I talked about our pretty extensive compliance checklist that we developed just for members. We have other resources on our library as well, including legal and compliance outlines, recordings of past webinars, and other materials. And as I said, of course, you can always contact me directly with any questions, or really any member of the legal team regarding any questions you might have about the marketing rule or really anything else. So.
Hey, thanks, Sanjay. So an important takeaway from firms' efforts to implement the marketing rule is how crucial it is that we help policymakers appreciate the real-world implications of their decisions and that they understand what it looks like to operationalize new rules. We're going to dive into some of specific topics soon, and we'll talk about potential real-world impacts. But before we get to that, we'll make some general observations on what we can expect to see from Congress following the midterms. And we'll also touch on several recurring themes that Karen mentioned that we are seeing in this tidal wave of regulatory activity. Neil, why don't we start with you and Capitol Hill?
Thanks, Gail, and hello, everyone. It's no secret we have a sharply divided government following the midterm elections. It's a hyper-partisan atmosphere. While there's little change in the Senate, major changes in the House, where Speaker Kevin McCarthy has, at best, a tenuous grip on a very narrow majority, which spells trouble for upcoming issues like increasing the debt ceiling. Bottom line, unless legislation has bipartisan support, it's unlikely to be enacted. If only for this reason, we're expecting, and we're already seeing, a major focus on oversight and investigations, especially in the House of Representatives. Nonetheless, we could see cryptocurrency legislation in this Congress, likely focused on stablecoin. It could advance, as well as legislation expanding the definition of accredited investor, something that the new House Financial Services Committee Chair, Patrick McHenry, is especially interested in, and which was the subject of a subcommittee hearing just yesterday. IAA will be advocating for legislation that would require the SEC to pay greater attention on the burdens of its proposed regulations on smaller advisors. This is a major importance to us, and we're hoping to advance that agenda on the Hill. Together with our members, we'll be addressing these issues on Advisor Advocacy Day on June 7th and 8th, and we hope that you and others from your firm will join us on Capitol Hill. Back to you, Gail.
Thanks, Neil. You know, we are not only advocating for smaller advisors on the Hill, but we're taking this directly to the agencies as well. We're using every opportunity we can to draw attention to the disproportionate impact of all this regulation on small businesses. You, though, are your most powerful advocates. So one of the things we've been doing is having meetings with groups of smaller members and SEC commissioners and staff so that they can hear directly from you about the unique challenges that you face. We're also pressing the SEC to step back and look holistically at the cumulative effects of all regulatory requirements on your firms, whether small or large. Policymakers need to appreciate how all these regulatory requirements taken together are affecting our industry and ultimately affecting your clients. Regulation of advisors needs to be both effective and efficient. And of course, it should support rather than undermine a strong fiduciary culture and robust investor protection. To achieve this, though, it must strike an appropriate balance between potential benefits and their costs to advisors, their clients, and ultimately the markets. So when we look at the current regulatory environment, we are seeing several recurring themes. For example, as Karen mentioned, we are seeing a troubling shift from principles-based regulation of advisors to a more prescriptive approach that takes away advisors' flexibility to tailor their compliance programs to their particular businesses. This top-down approach will not be able to keep up as our industry evolves, and it's going to run into what we're calling whack-a-mole, regulation. Something else that we're continuing to see is that as the SEC continues to try to raise the standard of conduct for broker-dealers, it's at the same time continuing to blur the line between fiduciary investment advisors and transaction-based broker-dealers. And this just exacerbates investor confusion. Retirement savings and climate risk are also both front and center, and the IAA is focused on highlighting the value of advice for the millions of Americans saving for retirement. We also strongly support policies in the retirement space and elsewhere that facilitate but do not mandate sustainable investing, and for that matter, any strategy. We're also focused on dramatic proposed changes to market structure and dealer regulation that could have consequences for advisors. The SEC also announced this week that it plans to finalize rules next week that will shorten the trade settlement cycle from T+2 to T+1. And the IAA supports that shift. William's going to talk a little bit about that later. So now I'd like to pull the rest of the team into our conversation so we can contextualize some of these themes for you. Let's start actually, William, with climate risk and ESG investing. What are we seeing in this space and how do you think it's all going to play out?
Yeah, absolutely. And thank you, Gail. So interest in environmental, social, and governance investing, or for short, ESG investing, has really increased exponentially in recent years, and at the same time has garnered the attention of the regulators. We anticipate that the SEC will finalize its rules requiring public companies to disclose ESG data and disclosures concerning advisors and funds, ESG investing strategies this year. The SEC's regulatory agenda also includes proposed rulemakings on human capital management disclosures and also corporate board diversity that could also be proposed this year. So for public companies, the IA supports consistent, comparable, and reliable disclosures of material information by corporate issuers on climate and other ESG matters. Now, for advisors and funds, members should be aware that the SEC rules will likely have an impact on your business. So even if you don't necessarily consider yourself as engaging in ESG investing. So for example, under the current proposal, for an investment strategy or an investment fund that considers any ESG factor, so even if it's one of several factors you're considering, and it may not even be determinative of the advice you're providing to your client, the firm would be required to provide enhanced disclosures, both to the SEC and your clients, either as an ESG integration strategy or an ESG integration fund. Members should also be aware that while we're awaiting these final rulemakings on ESG this year, the SEC is taking action now. The SEC is currently examining advisors concerning their ESG practices, and also in recent months, as you've likely seen, has brought multiple enforcement actions against advisors for what they see as deficient ESG practices. In short, the SEC is looking at all steps of portfolio management, but really with a focus on what they see as greenwashing, to really ensure that advisors are doing what they say and saying what they do. And if SEC scrutiny wasn't enough, over the past year, several states have also enacted laws to limit ESG investing, citing what they see as concerns that ESG investing is putting policy and social objectives ahead of financial objectives. The IA strongly believes that regulators should not dictate the investment strategy that should be used by fiduciaries. As Gail noted earlier, they should facilitate but not mandate ESG investing. We believe that different investment approaches have different benefits, and investors are ultimately deserved when policymakers limit those strategies that fiduciaries can follow to really try to maximize the value for their clients.
So William, how is the IAA tackling this quickly developing area?
Yeah, absolutely, Gail. So the IAA is very active in assisting members on how to approach ESG investing. We submitted comment letters on both the SEC proposals, the issuer proposal and the advisor and fund proposal. We have provided template SEC ESG exam requests on our website. We do have a very active ESG committee, and we're also having an ESG panel at our March compliance conference next month, where we will discuss these issues. Now, again, as much as I've talked about this today, while the regulators have been really active in the ESG space, unfortunately, the issue has also become really a political hot potato. So now I'm going to hand it back to my colleague, Neil, who can discuss how ESG is being viewed on the Hill.
Thanks, William. Well, it's no secret that there is abundant skepticism among Republicans, especially in the House, about ESG. The prevailing sentiment is that ESG evidences unwarranted woke capitalism. Representative Bill Huizenga, a Republican from Michigan, is the new chair of the House Financial Services Committee Oversight and Investigations Subcommittee. He's identified ESG as investing as one of his 4 targets for his subcommittee. And he was just named earlier this week to lead a new GOP ESG working group. I think legislation is likely to advance in the committee. It's not a top priority, but I think we're going to see it later this year. And it could advance and get to the floor of the House. However, prospects in the Senate are uncertain, and even in the remote chance something was passed by the Senate, it would likely be vetoed by the White House, and there wouldn't be the votes in the Senate to overturn that veto. And as I already mentioned, and we've told you, we believe lawmakers should just stay away from specifying the factors that advisors should or should not consider. And we will be impressing that viewpoint on Capitol Hill in the days and months ahead.
Thanks, Neil. And on that, it's not just Capitol Hill, it's not just the states, it's not just the SEC that are weighing in on ESG. The Department of Labor is active as well. William, what's going on there?
Yeah, absolutely. That's correct, Gail. It's definitely an ESG party. So the Labor Department is also active in the ESG space. For example, it did recently remove barriers to plan fiduciaries' ability to consider both climate change and other ESG factors when they select investments. We did support these changes and emphasize in our comments, again, that the selection of either an investment strategy and individual investments should really be left to the judgment of investment advisors that serve as fiduciaries, making decisions in the best interest of their clients.
Yeah, and one of the topics, one of the areas that we are really involved in is retirement, the retirement state. Neil, let's start with what's going on in Congress with respect to retirement.
Well, thanks, Gail. But first, I should mention some unqualified good news, which, of course, was that the Secure Act 2.0 retirement savings legislation was signed into law as part of the omnibus appropriations package at the very end of the 117th Congress. This was a big deal. It was strongly supported by IAA and its members and was a focus of our Hill advocacy. Of course, we support further efforts to bolster Americans' retirement savings, including efforts to expand access to retirement plans and to fiduciary advice. And while additional retirement savings legislation looks unlikely in this current Congress, the 118th Congress, we have to work now to lay the groundwork for future legislative efforts in the area.
So that's Congress. William, what is going on at the Department of Labor on retirement?
Yeah, absolutely. So as you may know, in addition to those ESG rulemaking efforts that I discussed just a few minutes ago, the Labor Department has been focused on how advice is provided to retirement investors. And they've been specifically focusing on rollover recommendations. So just for a quick background refresher, as a follow-up to its vacated fiduciary rule, the Labor Department officially reinstated its earlier 5-part test to determine whether a person is an investment advice fiduciary, and actually adopted an exemption that would allow fiduciaries to receive compensation for providing fiduciary investment advice. So as you may know, the rule is being enforced now. So if you're providing advice or making recommendations on rollovers either from an ERISA plan to an IRA, or from an IRA held at another institution and rolled over to an IRA under your management, and you'll also be providing ongoing advice after the rollover recommendation, there's a good chance that you may be subject to the Department of Labor's fiduciary rule, and you will need to rely on an exemption for that recommendation. The IA is currently updating our guide to the fiduciary exemption that's currently on our website, and we will be publishing additional documents to assist members in implementation of this rule, including guidance related to unsolicited rollover requests and also the retroactive review requirement. We'll continue also to hold calls over the coming months and assist with implementation of the rule. I think you should also be aware that the Department of Labor has proposed rules that would change the way it grants exemptions for prohibited transactions, and has also proposed to make changes to the QPAM exemption, the Qualified Professional Asset Manager exemption, which is a broad-based exemption that's relied upon by many advisors to actually allow them to provide services to retirement plans. The IA did submit letters on both proposals. We are actively engaging the Labor Department on these issues, and will also continue to provide guidance to our members on these issues. So here's what you really need to know about the DOL. With the fiduciary exemption in full force, ESG rule implementation going forward, a potential reproposal of the vacated fiduciary rule, and likely finalizing the QPAM exemption proposal, it's going to be a busy year. So please get involved with IA's DOL committee to stay current on these issues, and the IA can really assist members with implementation of both current and new rules.
So let's switch back to the SEC now and tackle one of its more impactful initiatives for advisors. Laura, let me turn to you. The current cybersecurity proposal reflects several of the themes that we've touched on. Where do you think it's all going to land?
So you may recall exactly 1 year ago today, the SEC proposed significant new cybersecurity rules that would require advisors and funds to report significant cybersecurity incidents to the SEC within 48 hours after having a reasonable basis to conclude that it either is occurring or has occurred with respect to either the firm or their clients. It would require advisors to have policies and procedures to address cybersecurity risks at advisors and service providers, conduct annual reviews of those policies to assess their effectiveness, and document that review in a written report. It would also require advisors to disclose cyber risks and incidents that occurred in the past 2 fiscal years in their Form ADV brochures, and also to maintain certain related books and records. This cyber proposal has been quite high on the SEC's agenda because the SEC views it as essential to the resilience of the financial system. So we do think it's likely that this rule will make it over the finish line. And our goal at the IAA has been to try to improve it for our members, to give you more time to respond to a cyber event before having to divert resources to file a report with the SEC, and to provide information to clients that would actually be decision useful for them, but without overwhelming them and without providing a roadmap for bad actors. We've also again pressed the SEC to tailor any new requirements to minimize the impact on smaller advisors. The IAA worked very closely with members of our Cybersecurity and Data Privacy Compliance Forum to submit very extensive comments on the proposal to the SEC, detailing the challenges and implications of the proposal for advisors. We also went in with members to meet with the SEC chair, other commissioners at the SEC, and the Division of Investment Management staff to express our concerns about the potential impact of the proposal on our members and to advocate for changes to the proposal. We are especially concerned that the SEC severely underestimates the costs of the proposal, especially for smaller advisors.
So speaking of costs, the SEC must do an economic analysis of its rule proposals, and there's a consensus generally that this one was sorely lacking. Have we been able to provide any helpful data to help the SEC with this type of analysis?
So actually, in response to these meetings that we had with the SEC, we did survey a wide range of our members to better determine the proposal's likely impact, and we sent those results to the SEC. Our survey consisted of 10 questions and 34 members responded, representing a range of firm sizes as measured by both ROUM and by number of employees. And we were able to show that our survey demonstrated that the percentage of revenue that firms currently spend on cybersecurity is definitely greater than what the SEC is assuming. We also showed that advisors rely heavily on third-party service providers to provide cybersecurity services. And we asked the SEC to take that into consideration and the fact that advisors need third-party expertise in this area. We also showed that the estimated initial and ongoing costs associated with implementing the proposal are much higher per advisor than the SEC's cost estimates. The IAA asked the SEC to update its cost-benefit analysis to incorporate our data and to modify the proposal to reflect these more significant costs that would be imposed on advisors. I think the survey results are also helpful because they can help members benchmark their cybersecurity related costs. So feel free to take a look at the survey results. They are on our website. So here's what you need to know about cyber. We do expect the SEC to adopt cybersecurity rules for advisors and funds in 2023. We expect that there will be a reporting requirement, but we are hopeful that it will be longer than the 48 hours that was proposed. The SEC is hungry for data, so the more data you can provide us to help move the needle on this proposal, the better. Please get involved with the IAA Cybersecurity and Data Privacy Compliance Forum to stay up to date on what happens with this rulemaking. The IAA will be here to help members with the implementation of any new rules in this area.
Thanks, Laura. And if the cyber proposal wasn't significant enough, the SEC followed it with a massive proposal at the end of the year that is creating huge headaches for members. The second proposal would require specific oversight, very sort of prescriptive items, oversight of service providers that advisors use. It basically wraps all of today's themes in a 300 or so page package. It's overbroad, it's prescriptive, it has strict penalties for even consequential violations, and it treats even smaller advisors as having virtually unlimited resources. Diane, I've made it sound pretty bad. Is it as bad as all this?
It's horrible, Gail. It really is. If adopted as proposed, the sweeping new rule would result in a sea change, not only for your existing vendor oversight processes, but also for the entire ecosystem of service providers that support investment advisors. The rule is intended to address perceived risk associated with advisor outsourcing of certain covered functions, but it would operate to prevent advisors from engaging service providers unless they meet minimum due diligence and monitoring requirements. As you said, Gail, the proposal is very prescriptive, departing from principles-based regulation and reflecting a check-the-box approach that's designed in part to give the SEC additional information to facilitate their exam and enforcement efforts. Now, a few thoughts from the IA on this proposal. First and foremost, we don't need this rule. Investment advisors already have a fiduciary duty with respect to all of the services they provide, including those that are outsourced. Secondly, we're particularly concerned that this is an anti-fraud rule, which could mean that your firm is slapped with a fraud violation for minor footfalls in compliance processes pertaining to vendor oversight. Now, taking a step back and looking at the outsourcing landscape for investment advisors, in the proposal, the SEC staff acknowledged that virtually all firms outsource, and this proposal would extend to virtually every stripe of service provider. To this end, the proposed rule is incredibly overbroad. For example, it extends to advisor affiliates, as well as to currently regulated entities such as broker-dealers and banks. Now, while it only applies to covered functions, these could vary widely from firm to firm and are defined in such a way that firms are likely to identify a huge number of potential covered functions because no one wants an anti-fraud rule violation. So how will this rule impact your firm? First of all, you're going to need to jump through a bunch of hoops before you engage a service provider or before you renew a service provider. Among other things, the proposed rules due diligence requirements mean that you would have to obtain, quote, reasonable assurances from service providers that they'll work with you for purposes of your compliance with the federal securities laws. Now, notwithstanding the fact that your service providers probably don't know or care what the federal securities laws are, firms often don't have the ability to negotiate with service providers in many instances. This appears to be an attempt of the SEC to regulate the service provider industry, which is well out of bounds for the SEC. In addition, firms would have to make information regarding their service providers public on their Form ADV, which could cause significant confidentiality concerns as well as competitive constraints. Of course, this would result in a profound cost burden, especially as firms are likely to be over-inclusive in their assessment of applicable covered functions. The proposed rule would also have a dire impact on smaller investment advisors and service providers that may be less able to hire and retain qualified personnel, which ironically could increase the risk of advisor insourcing in areas in which firms do not have expertise.
So Diane, just to be clear, right? We're not saying that today advisors do not have to jump through hoops to oversee their service providers, right? They still have to do due diligence on their service providers. It's just that it's not prescriptive and they can tailor it. So is that right? And how is the IAA responding to this rule proposal?
Yeah, that's absolutely right. Of course, firms are already overseeing their service providers. It's their client, it's their reputation on the line. So firms already have vendor oversight and they have fiduciary duty for the services that they provide. So we don't need a check the box checklist from the staff telling us how to do our business. So with respect to the latest scoop on what we're doing to make this proposal better, echoing what Laura said on cyber, we do believe the SEC is going to move forward with some form or fashion of this rule, whether it's necessary or not. So we're engaging constructively with members so that members will be in a better position to make the best of these new requirements. As mentioned, we've been meeting with SEC commissioners to discuss the impacts of the proposed rule on the industry, and we're working with members to make the rule not just possible, but practicable. As drafted, it would be impossible for even the largest firms with the most robust compliance budgets to comply with the requirements of this proposed rule. So what do you need to know about this now? First of all, we're currently working with members on the second of our 2 comment letters. The first letter that we submitted in December outlined our general objections to the proposal and its approach. Now we're working on our second letter that will include specific recommendations designed to improve the proposal. You're welcome to join us. You're welcome to review our ongoing work product. Reach out and please join our work stream. In addition, the commissioners are aware that this letter is upcoming. They are looking forward to receiving our comments because they're not on the ground like you. They don't know what sticking points you're going to encounter. So your input is valuable and we welcome any and all comments you have. Finally, though you surely have vendor oversight processes in place, maybe give them a fresh look. After all, this was on the 2023 exam priority list that was issued on Tuesday. So take a look at those, especially with respect to any associated cybersecurity issues and the selection and monitoring of service providers.
That's a great point, Diane. Switching gears now to another controversial proposal and another controversial example of this shift from principles-based regulation to strict prohibitions that we've been talking about today. And this is the SEC's private fund advisors proposal. And Monique, let me ask you, what does it mean for regulation of private fund advisors, this proposal that's out there?
Thanks, Gail. Well, members that manage private funds continue to face increased SEC scrutiny. On the rulemaking front, we do expect the SEC will adopt its proposal that could alter the landscape for private fund advisors. We strongly disagree with the imposition of outright bans under the Advisors Act, which the SEC is proposing. We believe that private fund advisors should be free to negotiate contractual terms with fund investors, including to limit their liability or be indemnified when they have managed the fund in reasonable and good faith. As written, the rules would apply retroactively, forcing advisors to renegotiate existing contracts. We have argued to the SEC that this would be unfair and unduly burdensome to advisors and investors alike. As with other rulemakings, the SEC has not adequately assessed the economic impact of the proposal on private fund advisors, including on smaller and emerging managers. The IAA made all these and other points in an extensive comment letter on the proposal last year, which we developed with the help of our Private Equity Fund Advisors Committee. This complex rule proposal will impact other existing rules like the marketing rule. Performance reporting challenges under the marketing rule will become even more difficult when the proposed quarterly statement reporting requirements are adopted. While we are calling for a different direction than what was proposed, this is an area where members should expect significant changes from current reporting conventions. The SEC's intense scrutiny of private fund advisors is also reflected in two proposals to significantly revise Form PF. We have urged the SEC to strike a better balance between its need for additional information and burdens on advisors in these proposals. So here's what you need to know. Increased oversight of private fund advisors is an SEC priority, and we expect that these rules will be finalized this year. The rule changes represent a major shift in the way the SEC regulates private fund advisors and will constrain advisors' ability to negotiate contractual terms, even with sophisticated private fund investors, and will require significant investments in technology and compliance resources. One important point to stress is that the SEC's proposed requirement to document annual reviews will apply to all advisors, not just private fund advisors. We will provide members implementation resources and forums to discuss interpretive questions, so please reach out if you'd like to get involved.
Monique, that's a really important point, that hidden in this rule that is directed at private fund advisors is this proposed requirement that all advisors are going to have to document their annual reviews. So I'm glad that you brought that up for those who are not following that proposal. Let's switch gears again, Monique, but let's stay with you. I want to reflect on just how broad the SEC's current rulemaking agenda is for advisors, and not just under the Advisors Act. There are also several proposals that are going to change market regulation in ways that are going to have lasting effects on advisors and their clients in the market. So where should we even start?
Well, let's start with the settlement cycle, which is one the IAA largely supports. As you mentioned, the SEC announced yesterday that it will adopt its proposal on February 15th to move from a T+2 to a T+1 settlement cycle. This proposal will include new record-keeping requirements for advisors, so please stay tuned for more details once that rulemaking is released. But as background, last year, the IAA engaged with the SEC staff on this proposal, and in our letter and meetings, we discussed some pain points that could burden advisors unnecessarily. We recommended the SEC adopt a policies and procedures requirement instead of a contract requirement for advisors to address allocations and affirmations with broker-dealers. We called for a delay in the compliance date from March to September 2024, and we asked the SEC to focus on challenges the rule will have on advisors that participate in the foreign exchange markets. So here's what you need to know. Members will need to implement new operational, contract, and record-keeping provisions around trading, and we'll learn next week what compliance date the SEC has selected in the final rule and other impacts on advisors. So again, we'll provide additional resources on the final rules once they are published. Another area we are following closely from members is related to a proposed SEC rule to redefine what it means to be a dealer of securities, including a government securities dealer. While the proposal exempts registered investment companies, the proposed amended dealer definition could capture advisors, private funds, and even SMA clients under vague and arbitrary tests of their trading activity, though it is not clear how many would be captured. If the rules are adopted as proposed, advisors and private funds could be subject to onerous monitoring requirements, among other dealer requirements such as net capital reporting and SRO membership. So here's what you need to know. Advisors are not dealers and should not be considered dealers under any circumstances, and the IAA has strongly opposed and continues to oppose this proposed expansion. And lastly, a package of proposed rules impacting members relates to changes to equity market structure and broker-dealers' best execution obligations. The rules will create an SEC broker-dealer best execution obligation for order handling of all securities of non-institutional customers. And that would build upon the current self-regulatory organization best execution rules. It will also increase obligations of brokers involved in payment for order flow. In addition, the proposals would require stock orders of individual investors be exposed to auctions before being traded by any wholesaler dealer. And the proposals seek to change the minimum price increments or tick size for equity stock quotations and trades, and will require brokers to provide additional execution information to the public, including to advisors. So here's what you need to know. We're working with our members to consider how the rules may impact advisors' best execution obligations and what impacts the proposals may have on liquidity and transparency of large client orders. While there may be more data on brokers' execution, it's unclear what impacts there may be on changes to payment for order flow and to commissions and soft dollars. So we do encourage your involvement in our work stream if you're interested in providing feedback on these proposals.
Thanks, Monique. So we should all stay tuned to developments here. It's not just the SEC and the Department of Labor that have been busy. We have no shortage of topics that we want to try to cover today. One event-driven topic is anti-money laundering, or AML. Neil and Diane, let me turn to both of you. What's changing in this area?
Well, first, I must mention our major victory in eliminating the overbroad and blunt AML provisions from the National Defense Authorization Act. The House last summer had added provisions from a Russian oligarch-focused piece of legislation called the Enablers Act to the defense bill. The NDAA, as it was called, was adopted at the end of the 117th Congress this past December, and advisor advocacy was critical in convincing Congress to drop these provisions. So those of you who are involved in this effort, thank you. Nonetheless, AML for advisors remains on the horizon, likely to be developed by Treasury's Financial Crimes Enforcement Network, known as FinCEN, which has real expertise in this area, unlike Congress. So Diane, what's going on at Treasury?
A lot's going on. This certainly hasn't gone away, Neil. And the good news is that thanks to your great efforts with our members, that this is now in the hands of Treasury per our recommendation. Of course, everyone recalls the proposed AML rules for investment advisors that came out in 2015. And at that time, we weighed in and pointed out that the vast majority of advisors pose no meaningful AML risk. They don't have custody of client assets, and transactions go through an intermediary that is directly covered by AML requirements. At that time, we called for a risk-based approach that would exclude low or no risk advisors. But now there's a renewed focus. As of year-end, FinCEN had 90 days to report to the Senate and House Appropriations Committees regarding the evaluation of the 2015 proposal. The Financial Action Task Force has identified the lack of AML regulations for investment advisors as an area for the Treasury to focus on in their priority actions. It's clear that this initiative is still in progress, and the question is merely when and not if. The good news is that the staff does not seem to be anywhere near issuing anything anytime soon, and also that they seem inclined to address gaps rather than a wholesale approach that they took in 2015. During our meeting with the Treasury staff, as Neil mentioned, their focus was on Russian oligarchs, but also on advisor processes regarding beneficial ownership, including with respect to private fund investors. So here's what you need to know now. First of all, we think at long last, the Treasury is likely to adopt some AML rules for investment advisors. Secondly, we expect this will be risk-based and look to fill in gaps. And so it may have broad exclusions where the Treasury agrees that the risk is low. And finally, now is a good time to look at your AML policies and procedures and give them a refresh. especially with respect to beneficial ownership information you or your service providers can solicit to help reduce your AML risks.
Thanks, Diane. And in keeping with the full regulatory agenda across the board, the Federal Trade Commission also recently issued a proposal that's going to affect many of your businesses. William, why don't you tell us about that?
Yeah, absolutely, Gail. So back in January, the FTC, Federal Trade Commission, did announce a proposed rule that would ban the use of non-compete provisions in agreements with workers. Now, this is a very broad proposal with very limited exceptions related to the sale of a business. So employers would be banned from using these clauses, not only with employees, but also with individuals such as sole proprietors and also independent contractors. Not only would this be prospective going forward, employees would have to actually go back and rescind their existing non-compete clauses and advise those former employees that those provisions are no longer in force. The proposal also uses what they call a functional test to determine whether the agreement is a non-compete agreement, which is broad and may actually include both non-disclosure agreements and also non-solicit agreements, which are both pretty common in the advisory industry. The IA has created a member work stream, so thank you for the members that have joined so far. We do plan on submitting a comment letter on this proposal. Our initial concerns really revolve around the potential impact on those non-disclosure agreements and non-solicit agreements I mentioned earlier, the impact on advisor M&A, merger and acquisition activity, and also that difficult situation of trying to go back to former employees and for those existing non-compete agreements. So here's what you need to know about this proposal. This proposal will impact all IA members. There's no carve-outs for regulated industries, no exceptions for certain other industries. So there is that proposed exception for equity ownership, but it only comes in if you own 25% of the business. So that ownership threshold may not be that helpful. Due to the breadth of the proposal, you should really consider now reviewing your current agreements just to get a sense of how the proposal might affect you.
William, let's keep you on the hot seat and turn to something else that's been getting quite a bit of attention lately, mandatory arbitration.
Yeah, absolutely. So, the use of these pre-dispute arbitration clauses in investment advisory agreements have recently garnered both congressional and regulatory attention. So the SEC is required to provide a report to Congress by June 27th of this year regarding how the industry is using these types of clauses in their agreements. The SEC will need to gather information concerning limitations on claims or limitations on damages that can be asserted under those agreements, whether any complaints have been filed against the advisor, and whether the firm has either any arbitration awards or unpaid arbitration awards in the last 5 years. The SEC's Office of the Investor Advocate has also recently completed a preliminary review of pre-dispute arbitration clauses in a random sampling of advisory agreements, and they're going to share their findings with both the SEC chair and the other commissioners. So here's what you need to know about arbitration. So the SEC has actually had authority for over a decade, going back to 2011 and the Dodd-Frank days, to actually prohibit or restrict the use of these clauses in investment advisory agreements. So we really do think with this increased interest, a potential rulemaking could occur that could impact the use of these agreements going forward.
Yeah, and one other need to know, I think, is that the SEC is also likely to look at whether advisors are disclosing arbitration claims or awards that the SEC is likely to view as material to an investor. So definitely more to come in this space. With the time that's left, I'd like to touch very briefly on just a few more rulemaking areas that we're keeping an eye on. Digital advice, crypto assets, and custody. We are expecting to see a rulemaking on advisors' use of technology to provide advice. This is also an area of concern for SEC exams, specifically focusing on how algorithms are managing conflicts, algorithms and predictive analytics. In our view, all advisors are fiduciaries, regardless of the method by which you deliver your advice. And this is a theme that we keep on bringing back to the SEC, treat all advisors the same under the Advisors Act, which is flexible enough to be adapted. Moving on to crypto. Digital or crypto assets is another area of focus, and it's also going to be coming up in exams. It's also obviously crying out for a unified approach to regulation, and there's some bipartisan support, as Neil mentioned. The IAA is forming a new digital assets working group, and it's going to focus on educating members on digital assets. We hope it will be a useful resource for all of you, and we hope that you will join us. More to come on that. Turning to custody, as I mentioned earlier, the SEC is voting on Wednesday to propose amendments to this critically important rule. Safeguarding client assets is of paramount importance to all of us, and it's important that controls are aligned with the actual risks. So we've been asking the SEC for years to modernize the outdated and overly complicated custody rule. So we're obviously following this very closely to see what the proposed changes are going to look like. Any proposal is also likely to include digital or crypto assets. So it's going to be interesting to see how that's handled. We have a custody working group, so please reach out to help us develop our positions once the amendments are announced next week. Okay, turning briefly to the SEC's exam and enforcement activities. As I mentioned earlier, the priorities are out for this year. We're going to hold a webinar soon to go through them in detail, so I won't take the time now. But not surprisingly, they include the perennial favorites: conflicts, custody, cybersecurity, private funds, fees and expenses, fiduciary duty, self-form CRS. There are several other areas of focus as well. Obviously, the marketing rule and compliance with the two new fund rules, the derivatives rule and the valuation rule, which recently went into effect. ESG is on the list, as is digital advice and crypto assets. Importantly, and this is new this year, they are going to be looking at policies and procedures around retaining and monitoring off-channel communications, basically the unauthorized use of texting and WhatsApp and things like that for business purposes. And they're also going to be looking at your oversight of the third-party service providers. So you would do well to review all your policies and procedures relating to these various focus areas. We continue to press the SEC to recognize the challenges faced by smaller advisors in advisory exams, not just rulemaking, but in exams. And also we've asked the SEC, when it shares observations in risk alerts and best practices, tailor them so that they are helpful and meaningful for smaller advisors as well. Let me turn to enforcement. The hottest areas right now are off-channel communications, which I'm sure you've all been hearing about and reading about. Several advisory firms are being caught up in enforcement suites. The SEC is facing quite a bit of pushback here, and we expect that we'll be talking about these issues for quite some time. We are here as a resource to help you understand these issues. One other troubling trend that I'd like to mention is that cases are being brought for technical or inconsequential missteps when there's really no allegation of client harm. We've seen this in cases involving pay-to-play, private fund audit reporting, and proxy voting. And that's why we are so intent at pushing back on the prescriptive requirements that are now coming up in proposed rules, because even a misstep of the prescriptive requirement could result in an enforcement case. With that happy thought, Karen, let me turn it back to you.
Well, thank you. And thank you to Gail, Neil, and our terrific legal team for that comprehensive and frankly daunting view into the policy landscape. We'll go into depth on these topics and more at our compliance conference on March 12 to 14. I hope to see you all there. We also offer other compliance workshops, roundtables, and webinars throughout the year. It is critically important that you get involved with advocacy on these issues. Members of Congress and their staffs need to hear directly from their constituents about how these policy decisions affect your firms and your clients. So join us, as Neil said, for Advisor Advocacy Day on June 7 to 8 to make your voices heard. We provide all the talking points, and it'll be a fun day on Capitol Hill. Another way to get involved and stay on top of all the issues is to join our Advocacy Council. This group meets regularly to discuss policy issues, both on Capitol Hill and at the agencies. They help to amplify our collective voice and shape our programs. And members of the council receive a 5 for Friday weekly newsletter on Capitol Hill activity affecting advisors and their clients. And we've had great feedback on that newsletter. Contact Neil with any questions. Get involved with our committees and working groups. As folks have mentioned, these various work streams, these committees are powerful venues for members to share common challenges, get to know each other, stay up to date on important developments, and provide us input on proposed rules and regs to help shape our advocacy. Members of our government relations and legal teams and the entire IAA staff are always here to connect you on any issue and connect you with each other. We provide resources to help you stay informed and engaged, including discussion forums, issue-specific calls, and written resources. I also want to remind you that all members can just pick up the phone or email us anytime to talk through any issues. We are here for you. Thank you all for attending this briefing and have a great afternoon.